Hello and welcome to this week's trading strategy video with me, David Jones, and Trading 212. I thought what we do this week is look at 4 things you should be doing before you place a trade and even before you start trading. They're pretty simple, but you'd be surprised at how many people just don't bother doing them. So it's a little checklist to go through before you place a trade. And at the end of this video, we'll look at putting it all in practice on a real market. So make sure you stay watching to the end. Let's get started. Point number 1, this is a really obvious one, but what markets should you be trading? In this day and age, there are tens of different markets you could trade, various currencies, commodities, indices, all these different markets. But I think maybe in the beginning, we spread ourselves too thin. We try and trade everything we see. Bitcoin in the news, so we think, right, this week I'm going to trade Bitcoin. Then the pound's falling because of something, so we'll look at the pound. Then stock markets are soaring, so we'll think, okay, we'll trade stock markets. But let's just take a step back and focus on maybe just 1 or 2 markets. So to give you some ideas, let's look at some popular markets. Let's take a look at the markets we can trade. Let's start off the ever popular FX markets. There's a whole host you can trade here, but some of the major ones that you might want to look at. Euro dollar is an obvious one. Pound, US dollar. Another popular one, dollar yen, dollar Swiss. So there are the 4 majors. You might want to take the dollar out of it altogether and look at something like euro sterling or even sterling yen. So we have lots of choice, and it's maybe an idea to focus on just 1 or 2 there. Stock market indices, of course, are also popular. It's up to you what you trade. But the major ones, the FTSE 100, known as the UK 100 with many brokers. Also the German market, the DAX, often referred to as just the German 30. Then, of course, if there are only one part of the world you could focus on, probably the US markets are the sensible ones. So we have the Dow Jones, which is known as the US 30, or the S&P 500, the broader US stock market, which is usually known as the US 500. Now, commodities are often a popular market for some. There's a whole host of stuff available to trade here, from some of the agricultural commodities, but probably the most popular ones, crude oil, the US version or the UK version. I think the US one is the most widely traded. And also gold, you know, as a precious metal that is seen, you can see it as either a commodity or a currency. So focus. I think it's much better to be an expert on 1 or 2 markets than have just a little bit of knowledge about a lot of markets. The second one we're going to look at, I think this is a really common one, is the idea of time frames. I think too many people, when they start trading, they get carried away with all the real-time data, all the short-term charts, and they start off just looking far too short-term. So how should we do it? Let's get an idea about how we should break those time frames down. If you're looking at a market, and let's say you identify a trend over the past few weeks that looks like this, and you're looking to catch what you think is going to be the next wave higher in this trend off until there, I wouldn't spend too much time worrying about a really short-term chart. Let's say like a 10-minute chart. Let's have a look on the platform in a second and put this into practice. So we need to decide what sort of time frame we're trying to trade. Now, the third topic, always a popular one with me, is the idea of stop losses. I think it's one that plenty of people get wrong. So what should we be doing with stop losses before we place our trade? You should be planning your stop loss before the trade goes in. You shouldn't be placing the trade and then worrying about the stop loss later. So if we're looking at a market and we think, right, I think this trend's going to continue, think about where your stop loss is going to go. We've covered this in previous videos, but let's think about looking at previous major levels. If we're expecting trends to continue, to put our stop loss beyond those, so we don't get taken out in the market noise. Let's look at a real market and try and plan this out. So here's the major US index, the Dow Jones, the US 30. You can see it up there. So we're looking at an hourly chart here. So you might be thinking about a shorter term trade. And you may think, well, we've seen something of a recovery from the market from around the 21,600 area up as high as 21,900. You might think that recovery is going to continue. So before you jump in and place a trade, think about the stop loss. We've seen it hold the last couple of days. It's held around about the 21,760 area. You can see I've highlighted on the chart, the market came back here and moved away. Before that, we saw a dip in the recovery that held around about 21,730. So looking at that chart, if this is the time frame I'm going to trade, if I'm buying here somewhere, just above 21,800, the logical place to have my stop is somewhere the other side of these levels if I'm looking at charts. So plan the stop before we put the trade on. And then finally, before you even place trade number one, this one is incredibly important. No matter how much money you've got in your account, whether it's 500 euros, $2 million, or somewhere in between, we need to think about the financial risk when we're placing trades. So let's take a look at that in a bit more detail. Before you even get around to clicking buy and sell on the euro, the Dow, the price of gold, you should think about how much you're risking financially on each trade. Most sensible approaches to trading suggest risking no more than 1 to 3% on any one trade. So what that means is, for example, if you decide to risk losing 3% on any one trade, you've decided on your stop loss. This is the thing that decides how big you're going to trade. So let's say your account is £1,000, €1,000, $1,000. It means if any trade goes wrong, you only end up losing 3% of the account on that one trade. I think the big mistake, we've covered it before, plenty of people do, they risk far too much. If you're risking 15, 20%, even more of your account on any one trading idea, it doesn't take much of a run of losing trades to do serious damage to your trading account. So think about this before you actually click buy or sell on anything. So there we go, a list of 4 things that are really straightforward on their own, but plenty of people ignore them and just jump in and wonder why maybe their trades aren't as well planned as they could have been. Let's take a quick look before we finish off about putting this all together on a real market. So a quick look at putting it all together. Here's our euro-dollar chart. It's clear what the trend has been over the last few months. For those who are fans of the MACD, it looks like it's almost getting ready to give us a buy signal. So the bigger trend is up. We might use the shorter term chart to maybe try and time our entry into the trend. Maybe if the market pulled back to the lows from the day before, a little bit lower than where it's trading currently. But then if we flip out to the big picture view, we can see a big level. If we're thinking about a longer term trade, a big level to place our stop beyond would be that 116.60 area I've highlighted in yellow in the chart. So then all we need to decide on is where our stop is definitely going to go and how much we're going to trade. So it's not difficult to put all this together. It just takes a little bit of thinking before you place the trade. So there we go. I hope you found this useful and it's going to add something to your own trading, whether you're just starting off trading financial markets or you're somewhere down the line. Don't forget, if you'd like us to cover anything in the future or you have any questions about what we covered today, leave us a message in the comments below. If you like the video, click the thumbs up, and we produce lots of videos on a regular basis, so to make sure you don't miss out, if you click that subscribe button there, you'll get notified when the next video gets uploaded. But for this week, from me, David Jones, and Trading 212, we'll leave things there, and I hope you have a good trading week.